From 1st January 2026, Nigeria's corporate tax environment enters a new phase. Finance leaders now need to understand one major reform, the 4% development levy.
This is not just another tax update. It affects tax provisioning, compliance planning, cash flow forecasting, and how companies model their effective tax rates for 2026 and beyond.
The development levy is a 4% charge on assessable profits. That means tax profits before capital allowances, tax depreciation, and loss reliefs are deducted. In simple terms, companies understand the profit base before calculating the levy. Before now, companies had to deal with several separate statutory levies. The new framework consolidates obligations such as TET Fund, NIDA levy, NASIN levy, and Police Trust Fund levy into one development levy. So, does this apply to every business?
Not every business. It generally applies to most Nigerian companies, but small companies, non-resident companies, and profits already subject to hydrocarbon tax are excluded.
That is why every finance team must first confirm whether the company falls within the taxable category. Small companies are also excluded from 4% imposed on assessable profits, further reducing their overall tax burden. The development levy is filed and paid alongside companies' income tax. Finance teams should not treat it as an afterthought. It should be built into the annual tax computation and provisioning process.
The proceeds are directed toward national development priorities.
50% goes to T8 Fund, 15% to the Nigerian Education Loan Fund, 10% to Defense and Security Infrastructure, 8% each to NIDA and NASIN, 4% to Technological Incubation, and 5% to cybersecurity. This reform may simplify compliance, but it also requires proper planning.
Finance leaders must review tax models, update forecasts, and ensure that provisions are accurate before year-end surprises occur. The 4% development levy is more than a tax reform. It is a shift toward a more coordinated funding model for national development. For finance teams, the message is clear. Review your 2026 tax models, assess the impact on your effective tax rate, make adequate provisions, and stay compliant.
Follow for more finance, tax, and business compliance updates.